Cook here from Mark to Market, brought to you by Mirrors Futures. It's Tuesday, time for Stock Index Technicals. I brought in Jared Levy. He's a senior market specialist for FME Group. Jared, I heard you on Bloomberg Radio yesterday talking about the VIX, and the question they posed to you was kind of an odd one. They said, why didn't the VIX predict the last market cascade? What was your answer?
Well, that's like saying I know what exactly the market's going to do tomorrow. It's impossible. The VIX is a relative indicator. The bottom line is the VIX is looking forward for 30 days of volatility, right? So if we look back 30 days and see where the VIX has been, or even over a longer period of time, the VIX helps us get a gauge as to where we are now. It's not going to predict anything, but when things start getting really cheap and really quiet, it's almost like a savvy trader. That should be a cue for a savvy trader to maybe begin to reduce risk, add some protection on. And another way to think about it is this. When options start getting cheap, right, that's maybe a good time to buy insurance, like a put or something, right? When the VIX is high, it's time to buy. When the VIX is low, it's time to go out of your long position. So as things are getting higher and higher and stuff's getting cheaper and cheaper, you can get a VIX down around 10 or 8%, when historically it never gets that low.
Right.
Maybe that's a time to start looking at protection or slowing things down.
All right. So the VIX is not a crystal ball because it's really just taking option prices from the SPX, the S&P 500 options, and taking those premiums and turning them into volatility numbers. It's sort of like implied volatility, and that's really just the market's expectation of what volatility might be.
Correct.
It's not a crystal ball.
And a lot of that has to do with, supply and demand too, right?
Right.
I mean, when markets are rallying, people are typically just buying calls, selling calls. Most people are optimists. A lot of people aren't thinking about protection. When everything's good and golden and great, nobody's worried about the markets falling. So they just keep, they're not buying puts necessarily, they're buying calls, selling them out right away, and that's why volatility tends to come in as the markets rise. It's an interesting phenomenon out there. I think people need to use the VIX and just take it for what it is. Look back at a snapshot, maybe 30 to 40 days, take that snapshot of a window, see your range, and see where you are currently in the VIX, and if you're in a high or low relative to that position.
Okay. You get a lot of futures traders, E-mini traders here and around the Merc that ask me, well, is the VIX an accurate measure of volatility for me as an S&P trader? And we've taken a look at this. I looked at it with Steve Clausen last month, and it really does track historical volatility. And one way you can keep an eye on this is if you go to the CME website, cmegroup.com. They've got some free charting. And you can pull up an S&P chart, either the E-mini or the big contract, and below you can select as an indicator 20-period historical volatility. So if you click on a daily chart and select 20-period historical volatility, you'll see that into November, historical volatility for the S&P rose up to 80 in early November, and then has now come down to just above 50. So, that's one way to keep an eye on it and see if it's tracking the VIX.
Yeah, it's a great, I'll tell you, as a former market maker in the Qs, I use the VIX in a lot of my trading to get a gauge on kind of where we are now relative to our positions. And again, where do I want to be going? Or do I want to be getting more long vol, short vol? Obviously professional market makers think a little bit differently than retail guys. The retail guy is worried about direction. The professional guy is worried about, okay, where's vol going from here? Market direction is a side note.
So let's talk about where the VIX is going and what's cheap or dear. When I heard your interview yesterday, I was thinking, well, in this new normal range, say 40 to 70, is 40 going to be the lower end here? Is that a place where potentially from here the market might take a big dive again, and the VIX shoots up to 60.
Well, 40% is a little bit around, I guess it's like 2.5% variation per day, somewhere in there.
Okay.
I'm doing that off the top of my head.
I think it is.
But I think, 40% vol is probably going to be a good support point for a while. Why? Still a lot of uncertainty out there. There's still that, potential of more bank failures and automotive failure, which could, again, have a rippling effect in the economy. I think moving forward, probably first quarter, as volumes stay heavy, we'll probably see 40 as support, maybe 70 on the top part. And then moving into summer, maybe 30, 20 goes, but who knows?
Right.
I mean, who knows? It's all relative. I use it to look at where we've been in the past 30 days and maybe get a gauge where we're going forward, but I don't try to make long-term predictions with the VIX. I think that's foolish.
All right, Jared, thanks for coming by today.
Thanks, Kevin.
Jared Levy from FME Group. I'm Kevin Cook from Mark to Market.